The wealth building phase is where millionaires are made. That's the green boxes and bars. This is important. Contrary to popular advice, you do not automatically enter the wealth building cycle just because a market has bottomed. Many markets bottom, then languish or flatline for years, sometimes decades. Those markets suck, almost as bad as falling markets because they lack the prime wealth building ingredient, appreciation. Some local markets shoot back up like a rocket. Without appreciation, all you've got is a job, chasing transactional opportunities. You're not creating massive wealth through leverage and appreciation, and life just passes you by. It's called opportunity cost. Your time is your only truly limited resource, and every day you spend in the wrong market or using the wrong strategies for that market is your lost opportunity cost. You need positive market momentum to create real wealth in real estate. I'll show you an easy way to spot momentum in a minute. Throughout this ongoing training, you'll hear me speak of becoming a total market master. In a nutshell, TMMers are momentum hunters because that's where the money is. Usually there are local markets all across the U.S. in the wealth building phase of the cycle, while at the same time other markets are in the transactional or declining phase. It's an ongoing process. Some local markets are entering a momentum phase while others are entering a transactional or declining phase, and vice versa. In any type of market, whether we're talking about stocks or bonds, commodities, and real estate, there are certain times when all the easy wealth is created, times when it's all lost, and times when it's like treading water and all you can generate is transactional income. All the wealth is created during the green times, so pay attention to the green bars at the bottom. Most of that wealth is lost during those times in red. In between, you've only got a chance at transactional income, flipping, wholesaling, that kind of thing. I mean, money is money, but transactional income is not the millionaire maker many gurus portray it to be. It's a job. If you stop doing it, your income stops. Even so, in these gray transactional phases, you can make more money, do more deals, and take less risk if you're in sync with your local cycles. You've heard the saying that most of the money made in the stock market comes just 17 or 29 days of the year, that all the other days are back and forth, up and down. The key is knowing which day is which. As you can plainly see, real estate is a lot like that. 2 steps forward, 2 steps back. Only much easier because it has very long, stable cycles. The chart you just saw is an average of all U.S. local markets. It won't help you much in your investing because you can't invest in an average market. You can only invest locally in a specific market. Local markets also move in cycles. We track about 400 of them, and the moves can be much more intense, the wealth creation much faster. Each local market has its own unique signature or fingerprint. No two are ever alike. That will become very obvious as we get into the upcoming videos. The same predictive tools invented 500 years ago and perfected by Wall Street work equally well at the local level too. And it works for both residential and commercial properties. Whether your local market is emerging, accelerating, flatlining, crashing, or somewhere in between, that knowledge is the foundation underlying all successful real estate investing. That's so important. Let's look at it.